Chairman Powell just around the corner, live from New York City this morning. Good morning, good morning. Equities down by about 1/3 of 1% on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Live from New York City, we begin with the big issue, some New Year optimism. Morgan Stanley ramps up bullish bets on China. Goldman Sachs drops its Eurozone recession call as the Fed tempers enthusiasm back home.
There's so much bearishness out there right now.
There's simply a lack of downside catalysts, a lack of downside surprises.
There's quite a bit of skepticism.
And therefore, the only way is up.
It does seem as if there's nowhere to go but up.
It's really a sequencing question.
News cycles or bull markets, they start in pessimism, grow in skepticism, mature in optimism.
It's not like we're super bullish.
It's been a fits and starts type of argument.
The only thing I'm going to say is, well, it's not going to be a Rocky Horror show.
It's been incredible how much the market, or how well the market has held up so far.
People are starting to drop recession calls for Europe.
There's a very good case to be made for China assets right now.
The balance of risks are a little bit more balanced than what the market is suggesting at this point.
Attention turning to Fed Chair Jay Powell this morning, delivering a speech at Sweden's Riksbank. For more, let's get to Mike McKee for more. Hey, Mike.
Hey, John, let's get right to the bottom line. There is nothing for you to trade on in his prepared remarks. Jay Powell, on a panel discussion about central bank independence, sticks to that. And he says the speech says there's no mention of the current economy or monetary policy, a short defense of Fed independence. If there's any headline, it's that Powell says the Fed should not try to influence social policy. There's one quote that is kind of interesting. Powell says, without explicit congressional legislation, it would be inappropriate for us to use our monetary policy or supervisory tools to promote a greener economy or to achieve other climate-based goals. We are not and will not be a climate policymaker. Someday, that may be a quote that comes back to haunt him or comes up in some kind of testimony, but it doesn't have anything to do with what the Fed is doing right now. So again, nothing to trade on. That does not mean you can turn this show off. You have to stay with John because you are going to learn something. And, of course, Jay Powell could always say something else, and I'll be back with that.
There is a Q&A session, right, Mike?
There is a Q&A session. Central bankers tend to be nerds, and they like to talk about stuff like central bank independence. So it may not come up in the questions, but the audience does get a chance to ask, and we will find out.
Mike, just a final one from me and from us. There's been a ton of Fed speak over the last couple of days. They're pushing back against rate cut forecast projections from market participants. Mike, is it carrying any weight in this market?
So far, it's not. I mean, we'll see what happens after Thursday's CPI and whether that really sets the market on fire in terms of lower rates going forward. But I refer you back to Raphael Bostic yesterday when he was asked about how long the Fed would keep rates high. He said, quote, a long time. And I think that's the message that we're going to hear from all of them.
Hey, Mike, thank you. We'll touch base with you in just a moment. No talk of monetary policy just yet from the Fed Chair Jay Powell. Equity futures still negative by about 0.2%. With us is Morgan Stanley's Matt Hornback, Matt Miskin of JH Investments. Gents, great to catch up with you. Two quotes here I want to start with. One from Citi, one from B of A. This from Citi first. This came from Andrew Hollenhorst, who had to say this. We continue to think Fed concern about loosening financial conditions amidst tightening labour markets implies unappreciated hawkish risk, including a 50 basis point hike on February 1. This is even more the case after the dramatic decline in Treasury yields last Friday. Bank of America and Mike Gapin followed up with this one. We do not see the Powell Fed as facing a new conundrum. The Fed should worry less about markets pricing cuts in 23. If the Fed commits itself too strongly to no cuts this year, then it risks leaving policy too tight for too long. Matt Hornback, first to you. Which one is it?
Hey, John, thanks for having me on, and Happy New Year to you and your family. Look, I think what is important here is two things. Number one, we have to recognize that market prices do not always equate to expectations. And in fact, if you look at the New York Fed survey of market participants, you can see that market participants do not expect the Fed to cut rates this year, even though markets are pricing rate cuts. That is really important, John, for your listeners to understand. Number two is that when you look at the inflation path this year, markets are pricing below target headline PCE inflation by the middle of the year. Now, I don't think the Fed is expecting that. In fact, I know the Fed isn't expecting that because not a single FOMC participant in the last summary of economic projections was even close to projecting below target headline PCE inflation this year. So we have to understand that this year is going to turn out much differently than what FOMC participants are currently expecting. And that opens up a lot of opportunity for investors, John.
So, Matt, let's talk about those opportunities. I went through your work. Here's a quote from you. Markets and data are starting to challenge the prevailing consensus views among investors and central bankers that post-pandemic inflation will look different than pre-pandemic inflation and that policy will be kept restrictive as a result. Matt, here are the trades. Embrace duration and curve steepness. Sell US dollars. Is that the conviction view this year for you?
It's a conviction view for the first 3 to 6 months, John. I do not think that 2023 is going to be, quite frankly, as easy as 2022 was. We had a year where a handful of factors drove markets in the same direction, more or less, right? So 2023 is going to be a year of multiple trends, multiple opportunities. The first one, yes, we think is to sell the dollar, curve steepeners in the US, embrace duration globally.
Matt Miskin, do you agree?
I think the dollar view is going to be a tough one if we get that risk-off environment where we go into a recession and inflation does come down. Now, I understand that weaker inflation could help weaken the dollar. I mean, the dollar has risen as inflation has gone up and Fed tightening. But if we get a recession, we get a risk-off environment, there could be a liquidity crunch. And investors globally and just businesses globally could run to the dollar. And we actually think that could happen in 2023. We like it as a diversifier. It's almost negatively correlated to all financial and real assets. And in 2023, if you do get another sell-off in equities or risk assets, commodities, the dollar could push higher. And we actually would have a modest positive dollar view. But I like the duration call from Matt into 2023.
Well, let's talk about the duration call and what's happening in this bond market right now. 2s10s, the yield curve over the last couple of days has been bull steepening. Why do you think that is, Matt Hornback? Where's that coming from?
Well, I mean, John, look, the markets, are pricing in risk premia. And what we've seen out of the data is that the risk is skewed towards weaker activity data than people were prepared for. I mean, it's interesting at just how the bond market rallied when so many people are in the hard landing camp. I mean, the data is surprising even them. Now, look, the labor market report from last week, John, had something for everybody. If you were bullish on the economy, you had things that you could point to. If you were bearish, you had things that you could point to. For me, what I make of all of that noise, the signal that I take is that incomes are going to slow. Income growth is going to slow. And that is the primary driver of spending growth, John. And at the end of the day, one of the main factors pushing inflation up has been demand. We think demand is going to slow. That should help inflation come down. And that's where we think duration, there's an opportunity here in the first 3 to 6 months of the year.
Well, it's helping yields at the front end come down, particularly on the 2-year. We're down about 25 basis points over the previous 2 days. And Matt Miskin, I've got to wonder why the 2-year yield is down. So in the market, I think for a lot of people, they see 2-year rates. If they're lower, they like buying risk. And I think the next step is to work out why they're lower. So let's talk about that. Are they lower for good reasons or bad reasons? We've seen a 2-year yield, Matt Miskin, come in because wage growth is softening. There's evidence of a soft landing emerging. Or are we seeing it for bad reasons because survey data, the ISM manufacturing services, are sub 50 and in contraction?
John, it was almost like you were watching the markets tick for tick on Friday, like the rest of us. Yeah, so on the jobs report, it wasn't the weakened wage growth that actually caused the 2-year yield to fall. After the jobs report, the markets were kind of just sitting there doing nothing. It was the ISM services report missed by a mile. And the new orders component of that, 45, John, 45. And that is when the 2-year yield tanked. And then it was just a spark of risk on rallying. Bad news is good news is such an interesting time to be an investor. And in the cycle, we think this is a late cycle dynamic where bad news is good news. It can only last so long. And John, as you know, earnings season starts out on Friday. And at the end of the day, it's about the profits that come in for companies, for equities. Profits drive equity prices. And I think in our view, The earnings season is going to be a tougher one. The bar is low, but the estimates for 2023 are still too high. We think that's actually going to drive equities to continue to see volatility, multiple contraction, and earnings estimates to come down over 2023. I know that was jumping off your 2-year yield, but bad news is good news. Is helping lift risk assets for now, but it can't do so for too much longer.
Well, Matt Miskin, to your point, is the bar low enough going into earnings season? Mike Wilson started the week over at Morgan Stanley by asking, how might the consensus be wrong? And he said it's not directional, it's basically about magnitude. He thinks that the earnings season is going to be terrible. Maybe we have an extra 20% plus downside from here. HSBC, Max Kettner, said this morning. Here's the quote from him. Having been staunch bears for much of 22, we think the consensus is wrong about a weak first half and second half rebound. We see a variety of reasons to be less bearish on risk assets in the first half, with depressed growth expectations being key. We actually caught up with Max a little bit earlier this morning. Here's what he had to say.
But we look at market pricing, so we look at things like equities versus rates. We look at equities versus rates against PMIs, or equities versus fixed income, comparing that against break-evens, so cross-asset relationships, or cross-asset against macro relationships. All of that looks a bit more, realistic now. And I think one thing that I would say is it's not like we're super bullish, right? It's not like I'm saying, growth is going to go through the roof and it's going to be rock and roll. The only thing I'm going to say is, well, it's not going to be a Rocky Horror show.
Matt Miskin, what do you make of that?
I think the toughest thing when I hear a lot of investors think about the expectations, look at earnings estimates, because that is the consensus built in. Earnings estimates for Q1 and Q2 are actually modestly negative. So if anything, that's the lower bar. The higher bar in Q3 and Q4 come into play. Analysts are estimating a massive earnings boom in the back half of 2023. And right now, it's the consumer discretionary sector, industrials, and financials. 3 massive cyclical sectors that are supposed to drive earnings growth in the back half of 2023. That's where the bar looks too high in our view. And overall looks too high. It just seems like right now the bottom-up consensus is for a economic recovery right through 2023. We think that's overly optimistic, given leading indicators, given the inverted yield curve, and given that PMIs are sub 50.
Matt Hornback, I want to give you the final word on this before we talk about EM, China, and Europe in just a moment. Matt, when you look at US growth expectations, are they still too high or are they low enough?
No, John, I think they're low enough. And where I think that growth expectations are probably more consequential for macro markets, including the US dollar, is when we look outside of the United States. If you think growth expectations are low here in the US, just look at Europe, look at Asia. Our view has been that China is a positive growth story for this year, and that's going to have lots of spillover effects to Asia more broadly, but also to Europe, John. And if you just look at natural gas storage in Europe, it has massively outperformed expectations. So all of the concern that was building up in the back half of 2022 with respect to the winter in Europe of 2023-24, there's lots of scope for growth expectations to rebound outside of the United States. And that's another factor that we think ends up weighing on the dollar this year.
We're going to talk about that next. Matt Hornback, Matt Miskin, sticking with us. Equity futures right now down about 0.2% off the lows. No real mention of monetary policy from Chairman Powell just yet. When the Q&A session starts, Mike McKee's going to jump back onto the set and run you through some of the headlines. Coming up, looking past the US for outperformance.
There's a very good case to be made for China assets right now. The dollar has topped in our view, and that is absolutely tailwind for the rest of the world.
That conversation up next.
We like European equities more than US equities, really like also in EM and in Chinese equities. Against the backdrop of Chinese reopening, just heard a bit of a pretty bold call around China growth. That's starting to happen now. People are starting to drop recession calls for Europe and for the Eurozone. All that really should be continuing in the next couple of weeks. And as that reappraisal really continues, that should be beneficial for EM equities and for European equities.
EM stocks back in a bull market. China's reopening giving a dose of optimism for Europe as well. Morgan Stanley ramping up bets on China, saying the following: we believe the market is underappreciating the far-reaching ramifications of reopening and the possibility that a robust cyclical recovery can occur despite lingering structural headwinds. Goldman dropping its Eurozone recession call. We no longer look for a Eurozone recession reflecting better growth momentum, sharply lower natural gas prices, and guess what? An earlier China reopening. Maria Tadeo joins us now out of Brussels. Maria, what a change in a couple of months.
Listen, Jonathan, what a change, because the European story was completely battered after the war in Ukraine. And today we have a change in tone, pretty much dramatic with that note from Goldman Sachs. They dropped their call for recession. They now see growth of 0.6% this year. It's not great, but nonetheless, it is growth. They cite all of the factors you referred to, the fact that we did not get this winter from hell. The temperatures were actually pretty mild. The storage, the fact that gas prices have really come down, and then this idea of China reopening being good for made in Europe. By the way, Deutsche Bank also had a similar note today saying this China reopening is positive for the euro. What I would stress, however, is now I just had a conversation just 5 minutes ago with the Belgian Prime Minister, who told me, yes, the worst case scenario has been avoided, but we want to see this feed to the real economy. We want to see consumer confidence go up. We want to see bills go down. And of course, inflation past peak become stable. This has been a real headache for European governments this year.
Hey, Maria, thank you. Great reporting over the last year, for that matter, the last several years, but of course over the last few days off the back of this story. Maria Tadeo, thank you. Over in Brussels. Back with us, Matt Miskin, Matt Hornback. Now, Matt Miskin, this is tough for a lot of people to listen to. They're trying to work out, should we be pricing an economic slowdown following tighter monetary policy in the West? Or should we be pricing a growth rebound off the back of China reopening? Which one is it?
It's a macro battle, and it's going to keep playing out here in the near term, and it's brutal. It's back and forth, and you're seeing, at the end of the day, our view, central banks are going to win it out just because they are more powerful on the global economy. And it's almost like right now there's two sides of a boat where people are rowing in different direction, because fiscal policy in China is continuing to provide stimulus. So we're seeing 9% of GDP being used to stimulus, a lot of credit issuance, debt issuance coming on the market. Every night you hear about China reopening, China stimulus. It's like they have a headline machine that just comes out every night, stimulus, stimulus. And lo and behold, Chinese equities are rallying, and you're seeing copper getting a bid. Germany also is going to be issuing the most debt in history, or in modern history, for their economy into 2023 to help mitigate this. It's amazing. But I'd say a lot of good news is priced in. I get it. It's better than the worst case scenario. But right now, if local currency equities in Europe are only down 5% off all-time highs, if earnings estimates continue to ratchet up, a lot of good news is being baked in, or I'd say the worst case scenario is being really taken off the table. We still see the U.S. going into recession. There's not been a period where the U.S. has gone into recession and it did not bring the global economy with it. And if that does play out, it still means weaker growth globally. Earnings likely need to come down. In our view, staying more defensive is a better tack through this challenging environment.
Can we get a DM-EM split? I think that's the question for many people. BlackRock and Whaley have this to say on that. We see DM economies facing recession. They go on to say DM central banks will halt rate hikes when economic damage is clearer. China's reopening and domestic spending will drive global growth as DM recessions hit. We like EM equities over DM, and we like high-grade credit. Matt Hornback, I want to come to you on that. Can we get that DM-EM split this year?
Well, John, I mean, I think it's probably even more nuanced than that. It's not clear to me that, those bucketings are really helpful for investors, given that there's so many opportunities out there this year relative to last year. I would say, with respect to the U.S., look, the economy is slowing, no doubt. And in fact, when it comes to fiscal policy, later this year, it's going to be a showdown, right? We just got a Speaker of the House. We know some of the concessions that were made in order to achieve that are going to make the battle over the debt ceiling more difficult to win towards the end of this year, John. So the fiscal trajectory in the U.S. could actually look much worse as we make our way through this year, versus what Matt said about the China fiscal policy and Europe fiscal policy. Those are pushing in a different direction in large part. So for my perspective, it's really the U.S. versus the rest of the world. And there, I think you can have some differentiation, which is, again, another reason why I think, the U.S. dollar can go down as global growth outside of the U.S. picks up.
That's an important distinction to make. And I want to go to you on that, Matt Miskin. The dollar weakness that you could get off the back of global growth exploding is rather intuitive, but you think perhaps we can get some dollar strength. Matt Miskin, how does that come about?
I think if the Fed really pivots and basically cuts rates, and the ECB actually raises rates right through it, yeah, I think that the dollar could weaken on that. I do struggle with a weaker global growth environment and the dollar going down. I think at the end of the day, it's more of a risk-off currency. It is more of a higher quality currency on a global basis. The euro has been on fire. It likely got oversold into the third quarter. I mean, the dollar last year in the first 3 quarters, that was the biggest move of any calendar year in history. It was up 18 to 19% in 3 quarters. It still was up 8, even though it lost 10 in the fourth quarter. But that dollar move, we're probably not going to get that big of an FX regime where that much currency movement is going to drive cross-asset into 2023. We probably had a lot of that pulled into 2022. But in our view, we think the Fed's going to stay relatively tight. The Bank of Japan's still doing QE like crazy. The ECB is likely to raise rates, but probably going to have to pause after weakening growth filters into the economy. And so we've got more of a modest positive view on the dollar for now.
Hey, guys, this was great. Matt Miskin, Matt Hornback to the two of you. I'll say Happy New Year just one more time, Matt Hornback, because you said it and I felt rude, but Happy New Year. And then we're done. Coming up in the morning calls and later, all eyes on a 2-year. Cameron Dawson of New Edge Wealth, looking to the short end for signs of recession. That conversation around the opening bell. 24 seconds away from the opening bow this morning. Good morning to you. Equity futures just slightly softer, down 0.2% on the S&P. On the Nasdaq, down about 0.4%. Chairman Powell speaking right now on central bank independence. The Q&A session should start shortly. And when we get that, if we get some headlines, Mike McKeel will run to the studio for you. There's the opening bow. Switch at the board and get to the bond market. Big move at the front end over the last couple of days. The previous 2 days, the 2-year yield down about 25 basis points. Trying to bounce here now on a 10-year yield up 5 basis points to 358.36. In Euroland, euro dollar 107.50. Euro dollar firmer by 0.2% on the euro side. Goldman earlier this morning dropping their recession call, and all of a sudden some optimism around the eurozone. We'll see if that sticks. Crude 75.40 at 1% at the moment on WTI. One stock to watch around the open is Coinbase, the crypto exchange initiating another round of layoffs and cutting 20% of the workforce. The CEO, Brian Armstrong, writing in a blog post, over the past 10 years, we became too focused on growing headcount as a metric for success. Especially in this environment, it's important to shift our focus to operational efficiency. Abby has more. Hey, Abby.
Hey, John. Yeah, and it's interesting because Brian Armstrong was also saying that this is the first time that there has been a downturn in the crypto space along with a macro downturn, sort of suggesting that that's a piece of what's going on. But one analyst at Oppenheimer saying that the reason that this company has now cut over the last 8 months in terms of company headcount for a third time, it has everything to do with the idea that volumes at their crypto exchange are down, especially after the FTX blow up. The stock, it's interesting, is higher today, up 1.7%. So maybe some relief on a stock that's down more than 85% since its IPO. The current cut about 20% or 950 staff. They cut about 1,200 people last June. They also cut 60 people somewhere in between. So more than 2,200 people over the last, let's call it 8 months or so, again, having to do with this slowdown in crypto trading. And they are cutting special projects. As a result, they're taking about $150 million in restructuring charges. So this is no small matter. And net income, back in 2021, when they did go public, they were putting up really solid net income of greater than $1 billion in 2 quarters, and in one case, close to $2 billion. Well, we're now looking at yet another quarter of negative net income. The crypto winter simply continues here, John. Very clear for Coinbase. But again, the stock is higher, so maybe find a little bit of relief.
Higher and keeps climbing. Abby, thank you. Now up by 8% on the session, 2 minutes into the open. Right now, equities almost unchanged on the S&P 500. Up 1/10% on the S&P, on the Nasdaq. Up 1/10% also. The restructuring we're seeing hitting firms across industries here. Apple's said to be looking at Broadcom, replacing those chips inside its devices with in-house components in 2025. With the latest reporting, here's Ed.
Yeah, good morning, Jonathan. We're down a percentage point on Broadcom. Not as severe as the reaction that we had when those headlines crossed. According to sources, what Apple will do is move away from the Wi-Fi and combined Bluetooth chip or modem set that Broadcom provides to Apple. This is actually a bit of a surprise because only back in December, Hock Tan, the CEO of Broadcom, talking about how good their chipsets were, how good their tech is. Less of a surprise is Qualcomm, because we've been talking about for a while how Apple wants to move away from Qualcomm. They've been in legal proceedings against them, and then as licensing settlement, which would lead to Apple having a 6-year period of cellular modems from Qualcomm, but then moving away in the future. Look, this is a big technological story, all right, about the modern day handset and Apple's move to bring not just supply chain, but do it itself on the technology front as well. We know that they're considering, generally speaking, how and where their handsets are assembled globally. But this is about controlling the IP and controlling the ability to update technology at a pace that suits them. For Broadcom, this isn't good. About 20% of their revenue comes from Apple, or about $3 billion. They account for around 7% of EPS. You see a lot of reaction on the sell side saying that the timing of this report is very interesting because Broadcom's most recent multi-year agreement with Apple expires later this year. So interesting move, fantastic reporting from Bloomberg's Mark Gurman. Less as a surprise, as I say, on the Qualcomm side.
Yeah, just to come to you on Apple just briefly, early February, we get the earnings from them.
Yeah.
The stock's put a run of gains together over the last few days. Tough month, though, over the last month.
Yeah.
Can you tell me just how low that bar is for that company?
Yeah, I mean, December was the worst month for Apple going back to May of 2019, and there was a complete revision for that full year 22 forecast in terms of overall handset shipments by a factor of around almost 20%, right, when you take into account all the different reporting around cuts. Ultimately, there is not demand for the lower-end products, and there is demand for the higher-end products, which they couldn't produce because of COVID disruptions in Zhengzhou. So it's going to be interesting to see not just the top-line result, because those ASPs may come down, which will impact revenue, but also margins as well, as they kind of scramble to untangle everything.
Ed, thank you, mate. Looking forward to your coverage on that story. February 2nd is when we get Apple earnings after the close that day. That stock is up by 0.8%. In the near term, we're just days ahead of bank earnings in America. Jefferies reporting a profit decline of 57% in its 4Q results. Shanali Basak on top of the story. Hey, Shanali.
John, you have to wonder if Wall Street's windfalls are now over and how long those windfalls are over for. You have a firm like Jefferies where you're watching investment banking activity fall off. However, you also have them saying that this is still one of their best years they're ending on ever, as well as activity levels not really going back to where they were in 2019. Still, Wall Street does not love it, because once you have activity start to drop off in that kind of way, you have a different equation in terms of how you meet margins, how you turn a profit when you're not willing to let people go. When it comes to Jefferies, they are still trying to send that signal that they are holding on to staff. They are looking for great staff. And of course, that report of Sumitomo a couple of days ago potentially increasing their stake. Jefferies itself did not answer to that. But at a time like this, competitive business on Wall Street, at a time like this, you like to make some more friends to drum up more business. Now, John, what does this mean for the banks that are coming up ahead? Jefferies, yes, the investment bank, no shocker, their activity falling off. But when you look at equities, also under pressure. Fixed income is a big winner here, which bodes really, really nicely, of course, for JP Morgan and Goldman Sachs, potentially even Morgan Stanley next week. Let's see if that's enough to keep the boom times going for these banks here, and whether it's enough to ink them some more money at a time where so many business lines are under pressure.
It's slightly unfair of me to ask, but if you could have one earnings report release right now from any bank on Wall Street, Shanali, who would it be?
You know I love my children equally, but, you know, I think that it will be interesting to see what the big consumer banks do. Those provisions for loan losses are expected to tick higher. And the question then becomes how much. We know investment banking is under pressure, but what about the consumer?
That's a good dodge, a very good dodge, Shanali. Looking forward to your reporting later this week. Thank you. 6 or 7 minutes into the session, the Q&A session just starting with Chairman Powell over at the Riksbank, the Swedish central bank. Mike McKee's going to drop by in about 5-10 minutes regardless, just to run you through what we're hearing from there. The takeaway so far, not hearing much. About 5 or 6 minutes into the session, call it 7, up a quarter of 1% on the S&P, on the Nasdaq, up 0.4%. Looking cross-asset right now, you've got high yield spreads tighter over the last several weeks. You've got EM absolutely ripping. You've got the dollar weaker. It does not scream global recession. Corporate America could be bracing for a slowdown. And Cameron Dawson, a New Edge, is looking for signs of the downturn in the Treasury market. She says this: is the re-steepening of the yield curve, that's the one to watch. When the short end is falling, that is the best indicator of an imminent recession. Cameron, I'm pleased to say, joins right now. So Cameron, the jargon for this is the bull steepener. You get that big rally at the front end, yields drop more there than they do at the long end. That's what we've seen in the previous couple of days. Cameron, can you tell me why that's more important than just, say, pure inversion, which is what people obsess with?
Yeah, because the inversion of the yield curve tells us nothing about timing. It can lead a recession by as much as 24 months. It really is that re-steepening that tells us when we're about to enter a recession. And importantly, we've never seen risk assets bottom before that re-steepening begins. And so what that re-steepening means is that it has to come from lower front end yields, meaning that the front end of the curve is pricing in a lot of interest rate cuts by the Fed, meaning the economic condition is weak enough to justify the Fed moving much more easy, much more accommodative. But what's interesting is that if we look at the 2-year yield today, sitting at about 4.2%, that is below the projected Fed funds rate. But importantly, that 2-year yield is right on top of the Fed's own projection of its yield in 2024. That's the median dot in 2024. So it really will be important to see if we see a further rolling over of 2-year yields. That's when the market will be truly concerned that we're going into an imminent recession.
Cameron, how well aligned do you think that bull steepening is with what we're seeing elsewhere? EM absolutely ripping, the dollar weaker, high yield spreads in America much, much tighter. How well aligned are those things?
Yeah, I think you're exactly right, which is that the data does not support that we are going into an imminent recession, which is why we don't think that we've really seen that bull steepening kick off in earnest. And the reality is that data within the U.S. simply does not support the Fed easing policy. And so we think even though we're not getting those hawkish comments out of Powell today at this meeting, we would expect further hawkish comments out of other Fed members as we go into the next Fed meeting in early February, simply because financial conditions, as you said, the dollar weakening and markets rallying, credit spreads tightening, they're all indicative of financial conditions now being as easy as they were back before the Fed's meeting back in August at Jackson Hole. And so that's when Powell really pushed back hard. And so we would expect further pushback again.
Well, Chairman Powell speaking right now in a Q&A session. One line here, the Fed tools work. One tool for the Fed, Cameron, has been Fed speak. And I just wonder how powerful, how efficient, how effective that Fed speak has been over the last week, because they all sound hawkish. And as you've indicated, the 2-year yield has started dropping in the face of that. This at a time when we've got sub-50 ISM readings as well. Cameron, do you think this market's responding to this Fed speak in a different way?
Well, I think we're locked in this really tough game of chicken with the Fed, because the bond market is still pricing in those 40 basis cuts into the back half of this year. And if you listen to Bostic yesterday, he said, I'm not a pivot guy, and asked how long he would keep rates high. He said a long time. And so the bond market completely disagrees that the Fed can hold its resolve and keep rates really tight. And it really is a question of if we start to see hard data start to roll over, because all of the weakness that we've seen within economic data has really been within soft data, survey data, sentiment data. It hasn't really showed up in real activity yet. And I think that's the big question for the Fed as we move into the next couple of months. Will we see things like jobless claims really tick up? Will we start to see income soften even further? And as of yet, we're not seeing that yet, which is why the Fed continues to talk so tough.
Well, Cameron, can I ask you a question that I asked our panelists a little bit earlier, Matt Hornback and Matt Miskin? I think it's an important one. What would you tell investors to position for? Should they be pricing an economic slowdown off the back of all this tightening, or an economic rebound off the back of China reopening? Which one is it?
That is such a great question. I think our preference when we're positioning is to try to be as agnostic to that path as possible, meaning buy companies that you can hold through different market cycles, quality companies that don't need the Fed being super easy in order to bail you out. Because we don't think the time to add beta in liquidity is really until you see a true pivot to accommodation by the Fed. So it means keep a little bit more defensive. You can layer in some cyclicals, but it has to be quality. So for example, we added a little bit to materials in the event that you do see a reacceleration in global growth, you do see a weaker dollar because of because of China reopening. And so I think that you have to be positioned for multiple outcomes, but the one we do not expect is a really easy policy shift in the very near term.
Favorite sector right now, Cameron? What is it?
So we like the combination of financials right now simply because of very, very low expectations. If you look at who has the easiest bar for earnings growth into next year, it is those financials. They saw their earnings decline 17%. Look at Jefferies in the fourth quarter, down 50% in earnings. That just creates an easy bar for earnings growth this year. And then we like to pair it with some more defensive sectors like healthcare, because we do think that in the event we do have an economic storm, you want some stability within the portfolio to be able to have stable earnings in an uncertain environment.
Hey, Cameron, thank you. This was great, particularly on the bond market. Enjoyed that. Cameron Dawson there of New Edge. Thank you very much. Your equity market looks like this about 13 minutes into the session. We're positive a little more than 0.1% on the Nasdaq, up 0.2%. No big headlines just yet from Chairman Powell. Mike McKee's going to jump on set in just a moment. Coming up, we'll talk politics as well. President Biden turning his focus abroad amid pressures at home.
All options are open. I mean, this is why we have, CUSMA in Canada, USMCA in US, and TMAC here. I mean, it's an agreement that also provides for mechanisms for dispute.
That conversation up next.
This is Bloomberg's The Open. I'm Lisa Mateo, live in the principal room. Coming up, David Cordani, Cigna CEO. That conversation at 10:30 a.m. Eastern, 3:30 p.m. in London. This is Bloomberg.
All options are open. I mean, this is why we have, CUSMA in Canada, USMCA in US, and TMAC here. I mean, it's an agreement that also provides for mechanisms for dispute. But of course, as trading partners, and trading partners that are like us, Canada, US, and Mexico, who do enormous trade volumes. I mean, I would say that this is one of the most successful trading relationships in the world.
President Biden in Mexico City for the North American Leaders Summit. Amid mounting tension at home, the DOJ reviewing classified files found in the president's former office. Plus, the White House facing questions over former President Jair Bolsonaro's presence in the United States. Team coverage starts right now. Bloomberg's AMH in Mexico City. Emily Wilkins down in D.C. AMH, walk us through the agenda today.
Well, Jonathan, first we're going to have a bilateral meeting just between President Biden and Prime Minister Trudeau. And then, of course, the three amigos, what they're colloquially known as, this is the North America Leaders Summit. They'll meet together. And already from what the White House is saying in terms of their fact sheet of deliverables, we can get a little bit of a sense of what they're going to be speaking about. Semiconductors plays a huge part in these discussions. They want to initiate a new semiconductor forum. They want to look at the labor intensity and the labor needs in terms of the workforce in North America to work in the semiconductor space and also shore up and integrate those supply chains a bit more. They're also going to talk about climate change, not just reducing emissions, Jonathan, but plans to install electric vehicle charging stations along their borders. And then finally, of course, migration, which is a huge issue back in the United States. They're going to try to coordinate more, share more intel and information on migration and on drug trafficking. When it comes to migration, Jonathan, they will be announcing a new portal for individuals who want to come from South America to apply to either go to Mexico, United States, or Canada.
Anne-Marie, just on trade, nearshoring has been a massive theme for a lot of people looking out to 2023, the year ahead, and for that matter, the decade ahead. Mexico, the big winner there.
They are a big winner. Already we see Mexican exports to the United States increasing. And AMLO didn't mince words yesterday with President Biden, talking about the fact, though, that he still sees ships from Asia with goods from Asia showing up in Pacific ports. And he really wants the United States to have more investment in Mexico. He wants the U.S. to not just back them when they go to development banks, but also jointly approach companies to build more in Mexico so they can supply the parts needed for, say, a manufacturing plant in Arizona.
Emily, that's the situation abroad in Mexico. Can we talk about the situation at home? Can you explain this to me? So we've got these files at the former president's office, and now we've got the DOJ reviewing classified files found in the current president's former office. Can you run us through that?
So when Biden was vice president, he did have a role at Pennsylvania University. He had an office that he used, and Biden's lawyers said that they found, that they found these classified documents in this office in a closet. They said they have notified the National Archives, which are now in possession of the documents, but of course, this raises questions about what Biden was doing with these documents. It raises a lot of concerns given how much hand-wringing there has been over the documents found at Mar-a-Lago. And I think this really opens up a lot of questions. This is not going to be the last that we hear of it. Republicans are more than ready to begin a number of investigations today. They're going to be looking into things including China, the origins of COVID, Hunter Biden's laptop. Expect to hear more of that. And this is something that they can very easily add to the list of things that they really want to dig into.
I can't keep up. That's your job, not mine, I guess. Emily, down in D.C., Emily Wilkins, thank you. MH over in Mexico City, Anne-Marie, thanks to you as well. Fed Chair Jay Powell, for those of you following, participating in a conference at Sweden's Riksbank. Mike McKee back with us for more. So, Mike, it's about central bank independence. There's a few of them sitting around facing some questions. Have we learned anything so far, Mike?
Nothing really. There is a question just posed to Jay Powell about liquidity in the system. And he says that he would prefer that we focus on structural reform rather than liquidity reform. But that's the closest you've gotten to anything on perhaps some kind of monetary policy. He was asked about whether the Fed felt the policies that the Fed followed during the great financial crisis and the pandemic crisis had worked. And he said yes, but that was in the context of changing policy so that Treasury had to be involved. So Treasury had to approve the methods that they used in the pandemic response. So it's still really all about central bank independence so far.
Well, Mike, you'd have to think they could ask a question here about the need of central bank independence at a time that they're explicitly telling us they're trying to put unemployment higher to get inflation lower. Don't they need independence to achieve something like that?
Well, he did say that central bank independence is helping the Fed because they have to make unpleasant decisions, things that people will disagree with to get to price stability, and price stability is the ultimate goal for the Fed. But you also have to remember this is a panel with 4 central bankers on it, or 4 current or former central bankers on it. So Powell is not the main focus, and he doesn't get all the questions.
And maybe you're not getting the diverse views you might be looking for. Mike McKee, thank you. Hugely controversial, that effort, I know, for many of you at home and beyond. 22 minutes into the session, equities down 0.1% on the S&P. The Nasdaq lower by 0.1% also, with some sector price action. Here's Abby.
Well, John, a little bit of a sleepy day here for sectors, and that small decline for the S&P 500 right now fluctuating. It has been fluctuating in the first half hour of trade on below average trading volume. This means that we do not have any sector trading. Well, we right now have utilities up down just a little bit more than 0.5%, but across the board, very small moves. Utilities down. This, of course, as yields are higher, making those dividends look less attractive. Healthcare is up top, discretionary up just slightly. Let's take a look at one tech sector that's moving just a little bit more, and that, of course, the chip sector. The stocks down about 0.6%. Broadcom, as Ed and you had been discussing earlier, Apple planning on making its own components. The stock down about 3%, but not so much. I can remember reporting on that possibility all the way back in 2016, 2017. So there's been a lot of knowledge of that in advance. But yesterday, this sector had a pretty good day. Today, giving back a little bit of those gains, John.
Abby, great work. Thank you. Over in Sweden then, bit of a snooze, quiet, not much news whatsoever. You know your next stop. CPI on Thursday, earnings on Friday. Your trading diary up next. Right now, 3,900 on the S&P. That's the level that Mike Wilson says is an easy sell. Are you a seller of this? Equity futures right now, or rather equities, are up by 0.25% on the S&P. That's the price action. Let's get you to trading diary. President Biden speaking alongside leaders at Canada and Mexico at 4:45 Eastern. Fed speak from Harker Bullard Barkin on Thursday. Plus, CPI data just around the corner. Jobless claims as well. Then on to Friday. JP Morgan, Bank of America, Citi, Wells Fargo, all kicking off big bank earnings at the end of this week. From New York, that does it for me. Thank you for choosing Bloomberg TV. This was the countdown to the open. Good luck for the rest of the trading day. This is Bloomberg.